Welcome to This is Getting Old. I'm your host, Melissa Batchelor, and today we're going to be talking about if you need long-term care insurance and some future trends. And I'm joined today by Marc Cohen. Welcome, Marc.
Welcome. Pleasure to be here.
So maybe before we begin, tell us a little bit about yourself and how you got interested in long-term care and long-term care insurance.
Sure. Thanks. Well, I've been in the field for a long time now, over 30 years. As a young graduate student at the Heller School, I started looking at use of nursing home care and assisted living. And one of the questions I asked myself back then was, is long-term care an insurable risk? And so that led me on a career to being among a small group of people to found a company called Life Plans that worked with the long-term care insurance industry, as well as conduct a lot of research on the issues of long-term care financing. And I led that company for a number of years and then moved over to UMass Boston, where I'm a professor in the gerontology department, and started a research center with colleagues in Washington, D.C. And I'm a co-director now of the Leading Age LTSS Center at UMass Boston. And most of my career has been spent on the issue of long-term care financing, which has been vexing policymakers for more than a generation.
Right.
And I'm still working away on it.
Okay, and then just define what LTSS means, because I feel like you might use that term again.
Right, LTSS is long-term services and supports. And basically, the best way to think about those are services that are designed to help people who have functional incapacities or limitations or cognitive issues perform basic activities of daily living, like bathing, dressing, toileting, all the things that one would need to live independently. So LTSS is just the acronym for long-term services and supports. One other point, unlike medical care and acute care, which those services, hospital care, physician care, tend to focus on curing people of certain ailments, long-term services and supports are designed to help people maintain their function or reduce the rate of decline in functioning.
Right, and long-term care, in and of, like as a concept, really, it's just a continuum of care once you really aren't able to live independently, but you need some level of support. And it goes from, home health that can help you within your own home. If you end up hospitalized and like break your hip and you're there for 3 days, then you can go to a skilled nursing facility for rehabilitation, or you can move out of the community and into assisted living or independent living, then assisted living. And then when you really are no longer able to even live independently in those settings, that's when we end up with kind of long-term care, like nursing home care, hospice and palliative care. So just to explain, when we're talking about long-term care, it's really this continuum across that can begin at any age, but it really just begins when you really can't support yourself independently any longer.
And on that point, Melissa, most long-term care, or LTSS, is actually provided by family and friends for people living in their homes. Another big difference from medical care, where you're getting doctors and so on. So you're absolutely right. There's a continuum that spans all the way from the home setting into institutional settings.
Okay, and so we're mostly going to focus today on kind of the financing of long-term care. So why don't you explain to us how long-term care is financed now, and then we can talk about the future.
Sure, thanks. So basically, long-term care is financed really in three major ways. First, there's out-of-pocket payments. Basically, elders and families pay out of pocket for the care. Second, there's Medicaid, which is a federal, state social safety net program, and I'll explain more about that in a minute. And the third way is through private long-term care insurance. And we'll talk more about that throughout our session together today. But those are really the three primary ways. And frankly, most long-term care is paid for out of pocket, primarily by disabled elders and their families. Roughly half, a little bit more than half of expected long-term care costs. But this varies quite a bit. So if you need nursing home care, for example, the Medicaid program pays for most of that care.
Well,
And
if you don't have any personal assets.
yes,
So let's,
that was the next point I was going to make.
okay.
Let me tell you that when it comes to Medicaid, there are a number of a really important thing, which is that in order to qualify for Medicaid, basically you have to reach certain very low income and asset thresholds, which basically means that many people who become functionally disabled and start spending money on care have to deplete their savings and so on. And then Medicaid will come in and act as a social safety net and pay for care. So that's one of the big challenges, is that especially for middle income elders, the idea that you would work your whole life, and if you get hit with a health event, have no alternative but to spend down income and assets and then become dependent on Medicaid, is a fairly unattractive option, even though the program itself funds a large amount of home and community-based care now and nursing home care. But because roughly half is paid by the state and half by the federal government, a lot of times Medicaid is competing with other policy priorities, so that there are waiting lists for services. So access is not always what you might want it to be. So there are people on waiting lists who need care, who can't get it right away. That's one of the big issues with Medicaid.
Right. Well, and each county is delegate or it has a certain number of Medicaid qualifying beds, particularly in a skilled nursing home. And so if those beds are full, then you're put on the waiting list until one opens up. So it's much more difficult to find a Medicaid bed than a Medicare bed. And I think that a lot of people that I've talked to, they're under the misunderstanding that Medicare would pay for long-term care. So just to make the point here, Medicare is just hospital-based, it's hospital insurance. And if you have a 3-day stay, it'll pay for the first 120 days of a skilled nursing stay for rehabilitation. But then after that, it's going to be out of pocket. So it is
exactly right. And worse yet, most people don't understand that. So you have more than 40% of people over 65 who still believe that Medicare covers long-term care. And there are some circumstances where limited amounts, for example, Medicare Advantage plans now through a new program that's focused on chronically ill individuals, will pay a little bit. But by and large, Medicare is not a serious player when it comes to long-term care. You're absolutely right. But it's hard for people to understand Medicaid, Medicare, and since there's a lot of denial to begin with about this whole issue, it's more comfortable for people to make an assumption, well, yeah, the government will take care of that. I don't have to worry about it.
right, which is not correct. I've been telling my students probably since the day I started teaching, it's like, if you think you're saving for retirement, you probably aren't, but you will be saving for your long-term care because that's where that's who pays for it. And they're, students in their early 20s are just shocked by that. And I'm not sure that gets better as you get older. So we've kind of laid down the nuts and bolts of like how it's paid for. So we have Medicare for hospital, some long-term care, but minimal. You have your personal assets, which, I've heard the term, you're self-insured with your personal assets. But, again, you have to deplete those before you would qualify for Medicaid and those services. And then we have long-term care insurance, which I've heard, my understanding was long-term care insurance wasn't a great idea. And even more so in the past couple of years, it's not been considered like the solution. So why don't you talk to me kind of about your thoughts about long-term care insurance and what role it plays in kind of the whole long-term care mix.
So I would probably not agree with that characterization that that's not a good idea. Let me just give a little bit of background. The idea, because of this problem that I mentioned, that people have to spend down their income and assets in order to qualify for Medicaid, especially for middle income folks, there was a question, well, what can we do to protect our assets? And what's interesting about the risk, long-term care, is that it's highly skewed. Now, what do I mean by that? I mean that a small number of people will end up using a lot of long-term care and have a lot of costs. Like 15% of people could end up spending more than $250,000 in care. And you don't know ahead of time where you might be. So those characteristics are like perfect for an insurance solution. Think about it like even homeowners insurance, right? There's a small probability of a fire destroying your home, but you would sure be happy to pay a certain premium to make sure that if that ever did happen, you'd be protected. And so in the 70s and 80s, insurance companies started to provide long-term coverage for this risk. They focused at the beginning on nursing homes. Then they expanded to home and community-based care. And so there was fairly rapid growth in the market, especially in the 90s. And today, for example, we have probably somewhere between 7 and 8 million people who do have private long-term care insurance. And there's a number of reasons why the market fell, sort of collapsed, and is only starting to really change. But for those people who have policies, they provide really, really quite good protection. And what do I mean by that? A lot of these policies give access to a fund, basically, a pool of dollars that if you become functionally disabled or cognitively disabled, you need someone to help you with activities of daily living, you can take this money and spend it in a nursing home, assisted living, home care. And we've done studies of claimants, people who are receiving benefits, and it has tremendous amount of benefit for the people who are accessing their benefits. Now, the question is, why are so few people actually having these policies? What has happened? And for a host of reasons, policies after the year 2000 started to undergo a lot of rate increases, meaning that insurance companies had to make assumptions about what it would cost to provide these policies. And some of those assumptions didn't bear out in reality. And for example, when insurance companies collected a premium and they'd invested in the market, and they assumed a certain return. Well, certainly from after 2008 in the United States, we had basically zero interest rate environment. So they couldn't get their returns on the premiums. They assumed that a certain number of people would go into claim and they'd stay for a certain amount of time. Some of those assumptions were inaccurate. And finally, there was an assumption that generally every year, for a host of reasons, people would drop their policies. A small number, but it turns out that once people bought these policies, they really held on to them. That also affected pricing. So you had all these reasons that insurance companies then were losing money and started to have to raise rates. Unfortunately, as rates increased, policies became unaffordable for middle-class Americans. And so the product became more niche for high-income folks. That is what has happened to the market. And a lot of players, the turn of the century, in the year 2000, there were over 100 carriers that were selling policies. Today, you've got maybe a dozen or so that are selling meaningful numbers of policies. The other point is that to try and make these more attractive, companies started to add long-term care coverage onto like life insurance or annuities, so that if you had a life insurance policy and you became disabled, maybe you could access life insurance benefits to pay for long-term care. And those policies have grown over the past number of years. They don't provide the same level of coverage as standalone policies did, but people felt that, well, you know, at least I'm going to get something, either a death benefit, or if I become disabled, I can receive some other benefits under the policy. But you're absolutely right. It plays a relatively modest role at best in financing the long-term care needs of the United States. We spend over $300 billion, and long-term care insurance is paying, you know, less than 10% of that amount. So there are a number of ideas that people have for revitalizing the market. And, you know, when you think about why is it that this market has been so difficult, there's also demand reasons. So like there's product cost, which I just mentioned. You brought up the issue of Medicare, and you're absolutely right. People misperceive that they already have coverage. People also tend to underestimate their risk. You know, it's a funny thing. When I give talks to professionals in the field, and I at the beginning of a talk, I'll often say, you know, how many of you think that you may need long-term care services in the future? Very few people raise their hand, even though these folks know that 1 in 2 people will have a significant long-term care need. Then I ask, how many of you think the person sitting next to you is going to need it? And everybody raises their hand. And so you have this level of denial. You believe you're partly covered. People tend to underestimate the costs. They certainly don't have a lot of trust in the insurance industry. And the product can be somewhat complicated for folks. So there's a whole host of other reasons that demand serious educational efforts so people understand what they're really facing. And then there's some of the supply issues that I talked about. You know, it costs a lot to sell the policy, some of the challenges on claims and interest rates and so on. So there's a lot of reasons, but there are things that can be done to improve the functioning of the market.
Right, and it's one of those, I mean, even just describing how the products change over time. I mean, there really is an equity issue too, that, you know, if only the people, you know, the highest people with the highest income can even afford the premiums, you know, then that in and of itself is kind of an issue too. So, so you mentioned, I'm really interested in how you actually do, I'm sorry about that, interested in how you actually estimate your risk. Like how would you even do that? Because I know that you have, like, you know, if you take 3 medications for 3 different things, that means you probably have 3 chronic conditions. Because I think about the way we say things as healthcare providers, we say, well, if you have more than 1 chronic condition, and I mean, I've talked to enough people that they're taking 5 medications, they don't think they have any chronic conditions, even though they've been taking the medicine for a year. So what are some things that you think about when you're thinking about calculating risk that people should be thinking about?
So it's, you know, the private long-term care insurance market is a voluntary market, right? It's not mandatory like Social Security or Medicare. So what that means is that insurance companies have to do underwriting, okay? They have to make sure that the risk pool represents an average risk pool, and you want to make sure that the only people that you want to prevent a situation where the only people who are buying insurance are already at extremely high risk for needing care. So they employ underwriting criteria. And I would say that it used to be the case that, you know, depending on age, roughly 80% of people who applied, especially if you're applying between the ages of, let's say, 50 and 65, most people were not screened out. In other words, we're able to get the insurance. However, if you wait, the older you get, the higher the likelihood that you're going to have a chronic condition, or you're going to be very close to needing long-term care. And so the underwriting, the rejection rates increase as you get older, which is a strong argument for purchasing this, let's say in your, between 40 and 60. I bought a policy when I was 45 years old. And so in terms of assessing risk, you're absolutely right that it's not, however, the fact that you may have a chronic condition. It's whether that condition is likely to manifest in a functional limitation. Okay,
Right.
Let me give you an example. I mean, it sounds counterintuitive. Suppose I want to buy a policy and I have a heart condition. Frankly, I'm a very good risk for a long-term care insurance company, a very bad risk for a life insurance company. So it's not as straightforward as saying, well, do you have a chronic condition? Or if you have something that is completely controlled, okay, some level of type of diabetes that's completely controlled, that doesn't automatically exclude you from being able to purchase the insurance.
Okay, so there is a role for long-term care insurance in paying for long-term care. So do you think it's still going to be a valuable product for people?
So here's my view. When you look at the long-term care financing problem in the United States, it's enormous. We know that of the people over age 65 today, something like 25 million of them are going to have a long-term care need. That's going to cost trillions of dollars, both in terms of family provided care, which is not often evaluated. People look at the dollars spent, but the dollars spent on, or the amount of care provided by families, if you put a dollar value to that, it's more than 7 times what our public program Medicaid pays. So the bulk of care is provided by families. So, and you have this situation now, and this is all getting to why I think there's an important role. You have this situation where you have smaller family size, where you have adult children that are highly mobile, they're living away from their parents. You've got families where both people are in the labor force. So this family caring network is really going to be stretched. And, we used to talk about the sandwich generation, where you had an older adult caring for an elderly parent as well as a school-aged child. It's getting to the point where I think of it as the panini generation, just being crushed by this. And so we're going to need to have more financial resources flowing into this system because of that. And my sense is the problem is so big that no one sector can handle it on its own. What I mean by that is I do not believe it can be a fully publicly financed solution. And we've already proven that it can't be a fully privately financed solution. So my sense is that we need some type of role for the public sector and for the private sector. And that's why I have spent a lot of time talking about and writing about and researching how these two sectors might play a role together. And when I talk about a role, I'm focused primarily on middle income folks. Really wealthy people, like you mentioned, can either self-insure or they can afford the private insurance that's out there right now. Really poor people have Medicaid, a social safety net, which is a good program. But what you don't want is the vast bulk in the middle making claims on that social safety net if there are insurance alternatives, be they private or public.
Okay, so you and I have talked before about this catastrophic public long-term care insurance program. And so are there public policy changes that are needed, or maybe explain what that even means?
Yeah. So remember a couple of minutes ago, I talked about the fact that there's this like very uneven risk, and that you have most people who need long-term care, the average amount of use is maybe 2 years or less, right around 2 years, okay? But you have this small probability, 15%, that use it for more than 5 years and so on. Well, it turns out that, and that risk is really catastrophic for a lot of people. I mean, if you thought you had to spend $250,000 in your retirement to pay for long-term care help, that would be pretty darn catastrophic. So what we've seen in the private market is that private insurance companies can no longer handle that catastrophic risk, that what's called long tail risk or long-term risk. That the private insurance industry is much better at handling folks who need care for 1, 2, 3, 4 years, maybe 5 years, okay? But they can't, they get in trouble with rating agencies who think that they're taking on uncapped liabilities. And so the private sector has stopped providing coverage for that tail end risk. And so the idea that
but how do they know if you're in the tail end? You don't know that going in.
You don't know that as a consumer, and the insurance company doesn't know when you buy a policy where you're going to end up. So for precisely that reason, they place limits on how long they cover you. That's exactly right.
Okay, so now that's making sense. You basically buy an insurance policy at 45. You don't need it till you're 85. But if you spend more than, like, whatever the limit is, we'll say $250,000, which is what you had mentioned. And once you spent that, then you're done. And you still have to go back, it's back to the self-paying model. But I wonder how much money you've invested in your premiums by then.
Well, here's what I will say. Leveraging insurance for this risk is a good deal, whether it's public insurance or private insurance, okay? Because I mentioned that half will have significant long-term care need. By that I mean they're going to have at least 2 functional limitations or be, severely cognitively impaired. But that also means that half will not have a need, right?
Right. And just want to clarify, when we say the term functional limitation, what my mind goes to is kind of the activities of daily living, which is your ability to dress yourself, to bathe yourself, to get dressed, to prepare your meals. Those are is basic activities that you have to do every day to take care of yourself, which is when home health is ordered. Like, these are the things that they will come in and do, help you get a bath or shower. So you have 2 or more of those, or you have Alzheimer's or some other cognitive issue. Now you can pick back up.
No,
I just wanted to make sure.
Right. No, exactly right. What you're saying. So, what happens? Just like you said, you still have this risk, and you don't know where you're going to be. The other point I want to make is that the idea of catastrophic. So it really varies by your economic circumstance, right? So if let's say you're relatively wealthy, well, you know that maybe you can afford you don't have to worry. You can pay for the first 4 years of care or something. But what if you're, lower middle income, and you may only be able to afford 1 year or 2 years? So the notion of catastrophic is somewhat variable depending on your economic circumstance. So the idea that we had, my colleagues, Professor Judy Fader at Georgetown and Melissa Favreau at the Urban Institute and myself, was that what if we had a public program that would cover the catastrophic piece of the risk, the piece that the private market won't, okay? And that private insurance would fill in the gap. And what we said is, well, it will depend, when the public program pays depends on your economic circumstance. So if you're lower middle class, the public program will pay after you've needed care for 1 year. If you're a little bit wealthier, maybe you have to take care of the first 2 years with your either your own savings or insurance, and then the public program kicks in. And if you're wealthy, then potentially you have to worry about the first 4 years of care, and then the public program provides coverage. And there are a couple of really nice things about that, I think. First of all, when you have a well-defined public role, remember earlier on I mentioned one of the big issues is that people just assume the government is paying through Medicare or or their health insurance pays for it. A clearly defined public role will help people understand, oh, I've got some personal accountability or responsibility for worrying about whether it's 1 year, 2 year, or 3 year. Okay, so that's number one. Number two, remember how we spoke a few minutes ago about when middle income folks access Medicaid, it's because they spend down their income and assets. Well, if you have an insurance solution for those folks, that means that you have fewer claims on the social safety net, which means that states will be able to have some fairly significant savings to their Medicaid programs. So it'll be quite attractive to states. And also, the people that will be accessing Medicaid are people for whom there are no alternatives. There are no insurance alternatives, and there are no savings alternatives. So it helps states quite a bit. The third thing that it does is that it will stream new money into the system. And let me just give you an example. All of us know what happened during the pandemic, especially in the beginning when the pandemic ravaged elders in nursing homes in particular, okay? Part of the issue is that we have underfunded the entire long-term care system. So there has not been enough money to support levels of wages that we need to attract and keep people working, develop career ladders, pay for high quality care and safety. And a public insurance program with private insurance filling in the gaps and savings will stream more money into the system, and everyone will benefit from a better system. So the long and the short of it is that if you clearly define roles, okay, and you tell the private insurance sector, hey, this is the part you have to worry about, develop products that are going to work in this area, and the public sector takes the really tough part of the risk, the catastrophic, you accomplish a lot of goals. Think about Medicare. You know, when we turn 65, most people buy what's called Medigap insurance, Medicare supplement policies. What do those policies do? They fill in certain gaps that the Medicare program doesn't cover. And a huge number of people have those policies as part of employee retirement benefits and so on. It's the same idea here. And so that was the concept. And now you said, well, what policies are there? It turns out that Congressman Swazi from New York has adopted this idea and is going to be dropping a bill soon called the WISH Act, okay, which is a catastrophic insurance program that covers folks depending on their level of income, either after 1 year of need, 2, 3, or 4, with a public insurance program that would be funded through a social security tax, or adding a small segment to the social security tax. And the idea would be that you would then know, as you're aging, okay, if I'm protected. I'm paying a little bit right now, and I'm buying myself insurance if and when I have a need. And I have to worry about maybe I can depend on my family for the first year of help or the second year, or family and savings. Or I can buy myself a new long-term care insurance product for that upfront risk. The idea is that by doing that, you then put together a package of comprehensive insurance that starts with the private sector and moves to the public sector.
Okay. So it's a lot to think about. We'll definitely keep our eyes out for the WISH Act when that's introduced. I think you've done a great job explaining kind of where we're at with long-term care financing right now, and kind of where we're at with long-term care insurance, but also where we need to be in the future. So do you have any other final closing thoughts?
I would say, I do have a final thought, which is that let's just take the WISH Act as an example, or any public insurance program. The first thing people go to is, well, how much is this going to cost? Is this going to increase taxes? And that's only half the equation, because there's a cost associated with doing nothing, and a cost associated with keeping the system as it is. And if I said to you, you would have to pay, let's say, $40 a month. I'm just making that up, but something like that. But you would relieve significant burdens on families. Women who tend to be the primary caregivers would not have to give up certain workforce opportunities and make workforce accommodations, which means that they could then be in the workforce longer, accumulate higher Social Security earnings when they retire, and have more security. That the quality of the infrastructure would improve significantly. You would be able to pay, for example, the workforce a living wage. You would be able to have reimbursement rates in nursing homes that could support high quality, safe care. You would reduce burdens on the financing for state governments so that maybe other policy priorities wouldn't be crowded out. If I told you that's what this is buying, and that the costs of doing nothing are so much more, you might think about it a little bit differently. And that's what I try to make the point, that sitting on our hands and hoping is not a strategy. This is a problem that has been around for a long time. And unless we take action, it's just going to get worse, because we're fortunate in this regard. It's no longer an accident that we live long. We expect to live long, but that brings levels of functional impairment and cognitive impairment that we haven't seen and we need to deal with. And because this problem necessitates bold action, it's going to require bold action on the part of the public sector and the private sector.
And I think that people just need to understand how expensive long-term care is. I mean, to just the housing for assisted living can be upwards of $70,000 a year. That's just your housing. That does not include medications you may need, the care that you're going to need in that within that. So I totally agree with you to think about it as a small investment now for a future that's a lot brighter, and to where people aren't just financially depleted trying to get care. But I think the main message I'm getting is that we also need to pay attention to our health and try to stay healthy. I mean, when you think about it, only 5% of people over 65 actually ever need skilled nursing care, and so
most care people need. It's you're absolutely right about that. It's a small number that needs skilled care. It's a big number that need the supportive care.
Right. And and it's not only the private and the public sector that needs to come together. I think there's a role for community-based services, community organizations, volunteers. Like we are all just going to have to pitch in. It's not their problem, it's all of our problems. And so I think
so well put. I wouldn't add a word. It's exactly right.
Okay, well, on that, thank you very much for joining us today and explaining the long-term care and the catastrophic long-term care insurance concept to us.
Been a pleasure. Thanks for having me, Melissa.
Thank you for joining me for this week's episode of This is Getting Old, Moving Towards an Age-Friendly World. You can find more episodes like this on my YouTube channel, Melissa B, PhD, and don't forget to subscribe. You can also visit my website, melissabphd.com, and check out the podcast and blog section, because that's where I put all the hyperlinks and different things that we may talk about in any given episode. You can follow me on social media, Twitter, LinkedIn, Instagram, and Facebook. And you can also find the audio version of the podcast on iTunes, Stitcher, Spotify, and Amazon Music. So I hope this podcast gives you ideas of different things that we can do to move towards an age-friendly world, because when the world is age-friendly, it's friendly for everyone.